A method is a consistent way of doing things. We have methods for everything in life. How we get ready for the day, how we interact with people, how we conduct business. Each pattern follows a calculation, a decision, a balancing of risk and reward, of investment and return, of the temporary and that which is eternal. Underneath the surface, our methods are really motivated by three things: what we think we want, what we want to avoid, and ultimately what we really desire. Money, madness, and the pursuit of lasting wealth. I'm Matt Hearn, and this is Method to My Money.
All right, a quick shout out to my friend Micah Brown of Micah Brown Media for helping me with that video. If you need help with anything video, Micah is your guy. He does great work, super creative. I think he handed me the script and said, here, memorize this. And then just kept filming me until I finally hit that jump shot there on the pool table. So anyway, he knows how to, if he can do something with this, then he can help anybody, right? So anyway, check him out. I'm excited to announce that we're kicking off a new series of webinars to be held monthly on Tuesday evenings at 6 p.m. Tonight we've had some technical difficulties, as I mentioned earlier, and we're starting a little bit later. But the series will be called Method to My Money, and we'll address some of the topics we get questions about most often from our clients. So join us on the second Tuesdays monthly at 6 p.m. live on Zoom using the same link that we emailed out to our clients, and we also posted on our Facebook page, same meeting ID, or live on Cannon Wealth Management Facebook page, and then also we'll post replays to our YouTube channel. So we'll be going through some timely topics. Those topics will include retire without a pay cut, which is tonight, kids in cash, preparing the next generation, financial simplicity, getting and staying organized, investing in a rapidly changing world, trimming your tax burden, finding peace in finances, providing for loved ones in sickness or in health, income and expense planning, where did the money go, right? Leaving a lasting and loving legacy, tax efficient giving, very important, small business owners planning for the next chapter, and finally, investing in your values. So we hope you'll mark your calendars and join us each month on the second Tuesdays at 6 p.m. If you miss a webinar, again, look for replays on the website, Facebook page, YouTube channel. Kimberly Stone is really good with client relations, and also she's our marketing person, marketing guru. She's in charge of all that. So if you have questions, reach out to her. I don't have any idea how to do any of this. So, but she's more into that than I am. But thank you, Kimberly, for putting this together. And if you enjoy these webinars, please invite your friends and family members, share on social media. We want as many people as possible to be able to view these as well. A couple of quick housekeeping things. If you are joining us tonight on Facebook Live, everything, you won't have access to the question and answer feature. If you are joining by Zoom, you can post a question there and on the question and answers tab, and I'll be able to see that, and I'll do my best to answer those questions later on this evening. All right, I'm going to share my screen with you again, and let's get started. Without any further delay, let's dive into tonight's topic, Method to My Money, Part 1, Retire Without a Pay Cut. Planning for a financially successful retirement. Do you ever wonder how you can transition from working and saving for your future to not working and spending your savings? What does that look like exactly? How will that work? Will you have to take a pay cut? Will you struggle? What about traveling, visiting grandchildren, enjoying your golden years? Will you be able to give back to help others who are younger or maybe less fortunate? There's not a subject that we get more questions on as financial planners than the subject of retirement. And what do we mean by retirement? Because that word can mean different things to different people. We want to define it tonight. What we mean is by retirement is that period of life when working and saving is no longer necessary and you can finally do full-time what brings you the most happiness, what I like to call what brings you lasting wealth. See, I don't really believe that having money is the same as having true wealth. There are plenty of people who have lots of money, but they aren't happy, or at least they don't seem to be. Happiness can be short-lived, right? I have spoken to many personally, and I have experienced this myself in my own life. Money that we think will make us happy does so for a short period of time, but it leaves us feeling discontent, kind of like a mirage in a desert. But there's a true wealth that is lasting, and it has nothing to do with what we can carry in a bank account or an IRA. True and lasting wealth is we might call wealth of soul. However, it does take good planning and smart money methods to bring us to a place where we can be free to enjoy that true and lasting wealth in the fullest way. Tonight, we're going to dive into some methods to our money that can help us retire with confidence and potentially avoid taking a pay cut, adding to our ability to focus on that which brings us true and lasting wealth in our retirement years. So let's start with 3 basic questions. What does retirement mean to you? What do you envision for your retirement years? As you pursue lasting wealth, where does that path take you? Will you travel? Will you take up a new hobby? What brings you lasting peace and happiness? Maybe it's spending time with family, volunteering your time, starting a new career or business. It's important to consider your goals carefully because your retirement income plan will be designed to support the retirement lifestyle that you envision. Second, when do you plan to retire? As we'll discuss, the age at which you plan to retire can have an enormous impact on your overall retirement income situation. When you partially retire for a few years in order to supplement your income or transition your business to a successor. So again, the timing is very important. And thirdly, how long will your retirement last? In other words, how long of a distribution period should you plan for? As a society, we are living longer and longer. How many years would you like to plan for? Let's spend just a few minutes discussing the last 2 questions. As we've mentioned, when you decide to retire, the timing of that can have an enormous impact on your overall retirement income situation. Let's consider early retirement. Most of us would like the chance to retire early, right? But early retirement can have significant financial repercussions. First of all, when you retire early, you're giving up what could be your prime earnings years. These are years which you could be making significant additions to your retirement savings. Also, the earlier you retire, the longer the period of time that your retirement assets will need to provide for your support, and the greater the risk that you will outlive your money. You have an impact on Social Security when you retire early. You can begin receiving Social Security retirement benefits as early as age 62. However, if you elect to start receiving benefits at age 62, your benefit may be as much as 25 to 30% less than if you waited for normal retirement age, which could be 66 to 67, depending on the year you were born. We'll discuss Social Security in a little more detail later. You're not going to be eligible for Medicare until you turn age 65. So unless you're eligible for retiree benefits through your employer, maybe have some health insurance coverage under a spouse's plan, or take another job that offers health insurance, you'll want to factor in the cost of paying for insurance and potentially additional healthcare expenses out of pocket, at least until you qualify for Medicare. Additionally, if you're fortunate enough to be covered by an employer pension plan, you'll want to check to make sure that it won't be negatively affected by your early retirement. Because the greatest accrual of benefits under a pension plan generally occurs during your final years of employment, it's possible that early retirement could negatively affect the benefits you receive. As you may expect, delayed retirement presents certain advantages when it comes to retirement income planning. The longer you work, the longer you'll be able to continue contributing to your savings. Even if you're no longer adding to your retirement savings, delaying retirement postpones the date you'll need to start withdrawing from your savings. And a shorter distribution period over your life expectancy there could significantly enhance your savings potential to last throughout your lifetime. In addition, delaying retirement may mean that you can delay taking Social Security retirement benefits, potentially increasing your annual benefit when you do begin taking payments. Continued employment may also mean continued access to company-sponsored health insurance. And then let's talk a little bit about working during retirement. So kind of a retirement, but a partially working as well. The obvious advantage of working during retirement is that you'll be earning money and relying less on your retirement savings, leaving more of your savings to potentially grow for the future and help to stretch your personal savings over your retirement. But in addition to that, full or part-time work during retirement could potentially provide access to affordable health care. More and more employers are offering health benefits to part-time employees as well as full-time employees. If you do work during retirement, you'll want to make sure that you understand how the income you earn might affect your Social Security benefits. While your earnings may increase your Social Security retirement benefits in future years, current benefits could be reduced. For example, for years before you reach full retirement age, $1 in Social Security retirement benefits will generally be withheld from you for every $2 that you earn at a job over the annual earnings limit. In 2020, that's $18,240. Special rules apply in the year that you reach full retirement age. It's worth noting that there are a number of non-financial reasons that motivate individuals to work in retirement. For example, you may value the social interaction, sense of accomplishment, structure that a career would provide you, and ultimately decide that full or part-time work, launching a new career, starting your own business, these things might be the right choice for you. One last observation on this: if you're working for an employer that offers a traditional pension, determine whether working part-time will impact your benefits. If your benefit is based on the final average pay, it's possible that working part-time for that same employer could reduce your pension. It could also be worth inquiring about any phased retirement program that your employer might offer. These programs allow you to receive all or part of your pension benefit while you continue to work on a part-time basis. When it comes to your retirement, how long a period should you plan for? The good news is that we are living longer. Americans are living longer lives. The bad news, that generally translates into a longer period of time that you'll need to have your retirement savings last. According to the National Center for Health Statistics, the average 65-year-old American can expect to live for another 19 and a half years. That was data from January of this year. Life expectancy has increased at a steady pace over the years and expected to continue increasing. And really the point I want to make is that for many of us, it's not unreasonable to plan for retirement that lasts 25 years or longer, which means your income and savings will need to last 25 plus years. Every retirement income plan has to balance three main goals: maximizing your ability to enjoy retirement, which means making sure you have the financial ability to do the things that make you the happiest long term and that fulfill you in the deepest sense. And then minimizing the chance that you will outlive your income. We tell our clients that it's not only our job to help you achieve your retirement goals now, it's also our job to help you avoid eating cat food at age 90. And then manage the financial risks of unwelcome life events such as serious illness, the need for long-term care, or other unanticipated expenditures that you or a family member may face. Once you know where your retirement will start, how long it may last, and the type of retirement lifestyle you want, it's time to start estimating the amount of money you'll need to make it all happen. First, you want to estimate your future retirement income or future retirement expenses to determine how much annual income you'll need during retirement, factoring in the potential cost of healthcare and even potentially long-term care. Then you'll want to consider the major factors that will affect your retirement income plan. For example, you'll need to adjust your annual income estimate to account for inflation, the rising cost of goods. You'll also want to understand the potential impact of taxes and investment risk. Then you'll want to total all your fixed income sources that you expect to receive. So Social Security, employer pension plans that you can count on, maybe a guaranteed income that you have coming from an annuity, something like that. You want to total all that up. When you compare your adjusted income needs to your anticipated fixed income sources, you'll likely find that you won't have enough income to meet your needs and goals. Closing this difference or gap is an important part of your retirement income plan. To supplement your fixed income sources, you'll have to rely on your retirement savings. How you should go about this, including the products and strategies that you should consider, depends on your current retirement assets, the amount of additional income that you need to generate, and the ability of you and your plan to tolerate risk, right? The volatility in the market. Let's look at step one in that process. It's estimating how much income you need. When trying to figure out how much annual income you'll need in retirement, you may be tempted to rely on some general guidelines. For example, you may hear that you should plan on needing somewhere between 60 to 90%, depending on who you talk to or read from, of your pre-retirement income when you retire. But using a general guideline like this, while easy, really isn't helpful because it doesn't take into consideration your unique circumstances, expectations, and goals. I mean, truthfully, it can be all over the place. The amount of retirement expenses you project to have can be totally different than just an arbitrary 60 to 90%. Instead of basing an estimate of your annual income needs on a percentage of your current income, focus instead on your actual expenses today and think about whether they'll stay the same, increase, decrease, or even disappear by the time you retire. While some expenses may disappear, like a mortgage or costs for transportation to and from work, new expenses may arise, like yard care services, snow removal if you're up north, or home maintenance, things that you might currently take care of yourself, but may not want to or be able to take care of in retirement. Additionally, if travel or hobby activities are going to be part of your retirement, be sure to factor these costs into your retirement expenses. While it may be painstaking, try to detail every potential expense you can think of. When we're going through this process with a client, we will use a planning software that provides many categories, and we'll walk through each category together. And we'll pull out a checkbook and a credit card statement, and we'll take a lot of time to make sure that this number is right. This can be time consuming, but it's very worth it because it's the most accurate way to identify what your retirement expenses may look like. Once you have a good understanding of your projected retirement expenses, you can solve for the amount of savings and time necessary to fund those expenses. One major retirement expense to consider is healthcare. Once you retire, you're likely to focus more on healthcare than ever before, and there's a greater chance that your health will decline. Most Americans are automatically entitled to Medicare coverage once they reach 65. And when you're eligible for Medicare, you've got to make some coverage elections. So you want to decide whether you want to purchase Part B coverage for medical care, including physician care, laboratory tests, and physical therapy. You may want to consider joining a Medicare prescription drug plan offered in your area by a private company or insurer that has been approved by Medicare. And it's important to understand that Medicare is not going to pay all of your healthcare expenses. For some types of care, you'll have to satisfy a deductible and make co-payments. That's why you might consider purchasing a Medigap policy that offers additional coverage. It's also important to understand that, well, I just said that, sorry, but yeah, just keep in mind that, of course, Medicare is not going to cover everything. But it's also the long-term care question. Some people still are a little confused about, and it's okay. It's hard to keep Medicare and Medicaid separate, right? But Medicare will not pay for long-term care expenses at all. Medicare, what pretty much everybody gets at age 65 in America, American citizens, they are not. That's not going to pay for nursing home. It's not going to pay for assisted living facility or in-home nursing care expenses if you ever need them. Because Medicare doesn't cover long-term care expenses, it's also important to consider the potential impact of a prolonged stay in a nursing home. But what exactly do we mean by this term long-term care? Long-term care refers to the ongoing services and support needed by people suffering from chronic health conditions or disabilities. It's hard to face the fact that our health might decline, but statistics suggest that most of us will need long-term care during our lifetimes at some point after we've reached age 65. Currently, the nationwide average cost of 1 year stay in a semi-private nursing home room tops $90,000. That's a study done by Genworth in 2019, cost of care. But in some states, actually in North Carolina, it's much higher. In the future, long-term care will likely cost even more. If costs rise at an average rate of 3%, which honestly that's a conservative estimate based on history, in 20 years, 1 year in a nursing home could cost approximately $163,000. If you needed it, how would you pay for long-term care? You might consider paying out of pocket, which means using your income, savings, investments, assets such as your home to pay for any potential long-term care costs. But paying out of pocket is truly a gamble unless you're wealthy. Many people assume that Medicaid will pay for long-term care costs, and it can. You may be able to rely on Medicaid, but there is a catch. To qualify for Medicaid, your assets and income must be low, so low that you really don't have hardly anything left. You will have to use up most of your savings before you can even qualify for Medicaid. And aside from a small personal needs allowance, you will have to use all of your retirement income, including Social Security, any pension payments, to pay for care before Medicaid pays anything. Another option to consider is long-term care insurance, which may provide a source of funds for long-term care expenses, but doesn't ensure that you won't have to pay for some of the costs out of pocket. And the premium for this insurance will need to be factored in to your retirement income planning. Before we move on to talk about retirement income sources, let's briefly review some of the factors that make retirement income planning so challenging. First, we need to account for inflation. Even if you can accurately predict your retirement expenses and can calculate the exact amount of retirement income that you'll need each year, you still have to adjust your calculations to account for inflation. You'll have to keep in mind that and account for the effect that taxes will have as well. Finally, your retirement income plan will have to balance the need for ongoing income with the level of risk that you're willing or able to accept. Unless you accurately account for inflation, you'll likely underestimate the amount of annual income that you'll need in retirement. Inflation is basically a general increase in the cost of goods over time. In other words, the purchasing power of a dollar will likely decline over time due to the rising cost of goods and services. At 3% inflation, a given sum of money will lose over half of its purchasing power in a 25-year period. Just put that into a real life scenario here. At 3% inflation, a gallon of milk that costs $4 today would cost $8.38 in 25 years. Keep in mind that inflation doesn't affect all goods and services equally. In fact, retirees can actually be affected in a disproportionate manner in the cost of some things. For example, the cost of healthcare has historically increased at a rate higher than the average rate of inflation. Basically, all other things being equal, inflation means you'll need more retirement income each year just to keep pace. The impact that taxes can have is sometimes overlooked. Taxes can eat into your income, significantly reducing the amount you have available to spend in retirement. You want to make sure that you understand whether income that you're counting on is or is not subject to tax. For example, many are surprised to learn that a portion of Social Security retirement benefits may be subject to federal income tax, depending on your filing status and your total annual income. You'll also want to make sure that you understand how your income is taxed. Keep in mind that some income, like interest, is taxed at ordinary income tax rates. Other income, however, like long-term capital gains and qualifying dividends, currently benefit from special, generally lower maximum tax rates. And some specific investments, like certain municipal bonds, generate income that can be altogether exempt from federal income tax and sometimes even state taxes. You should also consider, getting ahead of myself here, there we go. You should also consider, understand how distributions from tax-advantaged accounts like traditional IRAs and 401ks are taxed. Generally, to the extent that a distribution from the account or plan represents earnings or pre-tax contributions, in the case of a traditional IRA, deductible contributions, the distribution is taxed as ordinary income, regardless of whether investments within that account may have generated gain or loss or even qualifying dividends. So special rules do apply, though, for Roth IRAs, Roth 401ks, Roth 403bs, and Roth 457bs. Qualified distributions from these accounts are federally tax-free. Different types of investments carry different risks. Sound retirement income planning involves understanding these risks and how they can influence your available income in retirement. Risks that need to be accounted for include investment or market risk, the risk that the fluctuation in the investments that you have may result in the reduction or even depletion of the account and thereby hinder your retirement income plan altogether. Also, reinvestment risks. This is the potential that you may have to reinvest your money at a lower rate of return than the prior investment that came due. Take an additional risk to achieve the same level of return. This type of risk is often associated with fixed income type of investment instruments like bonds or CDs. When the investment matures, comparable investments may not be paying the same interest as that of the matured investment. And then interest rate risk. Now, this is very important for today. When interest rates rise, which they're very low now, as you know, and they may rise in the future, the price of some existing investments will drop. For example, during periods of rising interest rates, newer bond issues will likely pay higher coupon rates than the older bonds that may be in your portfolio, thus decreasing the market value of the older bonds. You also might see the market value of some stocks and mutual funds drop due to interest rate hikes because some investors will shift their money from these stocks and mutual funds to lower risk fixed income instruments paying higher interest rates compared to those in prior years. All right, let's talk about a three-legged stool. After you've estimated the amount of annual income that you're going to need in retirement, it's time to determine how much annual income you can already count on. Traditionally, retirement income has been described as a three-legged stool, comprised of Social Security retirement benefits, traditional employer pension plans, and individual savings and investments. The first two legs of the stool, Social Security and employer pensions, produce a steady or relatively fixed stream of annual income that you can depend on during retirement, at least assuming that the company issuing the pension is reliable. As we'll see, though, most people aren't going to be able to rely on Social Security to provide for all their retirement income needs, and you may not have enough of employer pension either. That means the third leg, individual savings and investments, is likely going to play a major role in funding your retirement. Let's look at the first two legs of the stool quickly: Social Security and employer pension income. Today, 97% of those 60 to 89 either receive Social Security now or will receive it soon. The amount of Social Security retirement benefits you receive is based on the number of years you've been working and the amount you've earned. The benefit is calculated using a formula that takes into account your 35 highest earnings years. The best way to know how much you can expect in benefits is to sign up for My Social Security account for a My Social Security account on the Social Security website to view your Social Security statement online. Your statement contains a detailed record of your earnings, as well as estimates of retirement, survivors, and disability benefits, and other information about Social Security. If you're over age 60 and you have not signed up yet for an account, you will receive a statement in the mail each year about 3 months prior to your birthday. The earliest that you can begin to receive Social Security is age 62. If you decide to begin receiving benefits before normal retirement age, which ranges between 66 and 67, depending on the year you were born, there's a drawback. The monthly benefit will be permanently reduced. In fact, if you begin taking benefits at age 62, each monthly benefit check will be 25 to 30% less than it would have been if you had waited until full retirement age, and that reduction is forever locked in. Conversely, you get a higher payout by delaying your benefits past your normal retirement age up to age 70. There's no good to wait after age 70, but there is a benefit to waiting to age 70. Of course, even though you're taking retirement benefits if you take retirement benefits at age 62, you'd be getting a smaller monthly check. You will end up receiving more benefit checks. So it's important to kind of run those numbers, and we can help you with that. Use a Social Security maximizer tool to try to determine the break-even point for you and look at all the factors there. For example, if your normal retirement age is 66, opting to receive benefits at age 62 means you'll receive 48 additional monthly benefit payments. We've already mentioned that working in retirement can also affect your Social Security retirement benefits, and that's something you'll want to keep in mind. Also worth noting, the federal government periodically adjusts Social Security for inflation. So that's helpful. The bottom line, for most people, Social Security alone isn't going to provide enough income in retirement. Now let's quickly talk about employer pensions. If you're entitled to receive a traditional pension from an employer-sponsored retirement plan or pension plan, you're lucky. Fewer Americans are covered by such plans every year. If you haven't already selected a payout option, you'll want to carefully consider your choices. Generally, your retirement benefit is an annuity. It's a type of an annuity payout, payable over your lifetime, beginning at the plan's normal retirement age, typically age 65. Many plans allow you to retire earlier, but will actuarially adjust your benefit to account for the fact that the payments began sooner and will likely last for a longer period of time. If you're married, your plan must generally pay give you the option to pay your benefits as a qualified joint and survivor annuity, QJSA. A QJSA provides a monthly benefit payment for as long as either you or your spouse is alive. The payments under a QJSA are generally smaller than under a single life annuity because they continue until both you and your spouse have died. The spouse's QJSA survivor benefit is typically 50% of the amount that you receive during your as the employee. Your plan may offer other options as well, including the possibility of taking a lump sum distribution. The option that's right for you depends on your individual situation, including you and your spouse's age, health, other financial resources. Make sure that you have a complete understanding of all your options before making your decision. You also want to make sure that you know whether or not the plan offers inflation adjustment. A lot of them don't, but it's important to find that out. Prior to retirement, your pension plan will provide you with an explanation of all of your options and the relative values of any optional forms of benefits available to you. Be sure to read through this documentation carefully. One thing we run for our clients who have pensions is a present value calculation. This provides them with the idea of what their pension is worth in today's dollars as a lump sum. In other words, how much money would they have to have as a lump sum to replicate the stream of income promised by that pension plan? This helps in determining if it might make sense to take the lump sum rollover into an IRA instead of taking the monthly lifetime payments. Let's just pause for just a moment and think about this conceptually. If you compare the annual income that you're going to need in retirement to the annual income that you count on from Social Security, retirement income, employer pension benefits, you're likely to find a gap. That is, unless you're lucky enough to have a very generous employer pension. You're going to have unmet retirement income needs that will have to be funded with the third leg of that retirement income stool, personal savings and investments. Some general considerations here. When we're talking about your personal savings and investments, we're talking about funds that you have either in tax-advantaged accounts, like an IRA, 401k, 457 plan, 403b, as well as any investments that you might hold outside of tax-advantaged accounts. When it comes to putting together a plan to convert your personal savings into a source of retirement income that fits your needs, there are several factors to consider. First and foremost, the challenge is to implement an investment strategy that provides, with reasonable certainty, for the annual income that you need, while balancing that need for regular income with other considerations like liquidity, your risk tolerance, anticipated rates of return, asset allocation. It takes into account all of these different factors. Deciding how much money you'll put into various types of investments is a very important part of developing a retirement income strategy. Building this investment allocation that really, historically speaking, has been able to generate the income you need with a level of volatility that you're comfortable with can be quite challenging. It is crucial to put together a successful retirement income plan, and this is one of the areas that we find that folks really need help with. Beyond general asset allocation, you should become familiar with specific investments and products that can play a role in your overall investment strategy. Which investments are most suitable and appropriate for your unique retirement income situation? Your withdrawal rate is the portion of your portfolio that you withdraw or liquidate each year for income. So this is also very important to think about. The question is, how much can you withdraw each year without ultimately exhausting your savings? So thought needs to also be given to the order in which you tap various accounts. For example, tax considerations can affect which accounts you should use first and which accounts you should draw from later. It is important to understand how current tax law affects you and even the sunsetting provisions in the current tax law, and how you can best plan to reduce your tax bill in all phases of retirement. You'll also want to consider upfront how you'll deal with required minimum distributions that may be due. These can be required from tax-advantaged accounts like 401ks and traditional IRAs, or whether these will even be a factor at all is important to consider. During your accumulation years, your asset allocation, as we've already mentioned, may have in the past focused more on long-term growth. But in retirement, the demands of your portfolio are likely to be very different. For example, when you were saving in your accumulation years, your working years, as long as your overall portfolio was earning an acceptable average annual return, you may have been happy. However, now that you're planning to rely on your savings to produce a regular income, the consistency of year-to-year returns and your portfolio's volatility may assume a much greater importance to you. Why is this? Well, because withdrawing funds from your investment portfolio during and immediately after a period of market volatility can be devastating to your retirement income plan, especially if it happens early in your retirement years. Let me give you an example. Let's say you're withdrawing $50,000 a year from a $1 million investment portfolio, but then the investments lose value by 20% or $200,000. Now, in order to continue funding your retirement income, you withdraw another $50,000, right? However, because of that reduction in value, because of the market volatility there, you must sell 20% more shares out of your portfolio in order to withdraw the income that you need. Essentially, you have liquidated 20% more of your portfolio than normal, making it much more difficult for that portfolio to recover its previous value. So instead of this, we recommend a bucket strategy. This is a strategy where we strive to have a portion of our clients' retirement income portfolio invested in a more conservative, interest-bearing fund or account that is less likely to drop in value in a market downturn. Balancing the need for both immediate income and long-term returns can be a challenge. Investing too conservatively and your portfolio may not be able to grow enough. Invest too aggressively, and you could find yourself having to withdraw money and sell securities at an inopportune time with the market being down because you were invested too aggressive. Jeopardizing future income and undercutting your retirement income plan is all possible if you don't get your asset allocation just right. Without proper planning, a market loss that occurs in the early years of your retirement could be devastating to your overall plan. I've seen this happen. Why? Because withdrawing funds from your investment portfolio during and immediately after a period of market volatility is just selling low, and that's the one thing you want to try to avoid. Now, let me just mention, asset allocation, of course, does not guarantee a profit or insure against a loss, but it can help you manage the level and types of risk you take with your investments based on your specific needs. It can provide ongoing income needed to pay expenses. It can minimize asset volatility. It can maximize likelihood that savings will last as long as you need your savings to. And good asset allocation can help you keep pace with inflation in order to maintain purchasing power over time. A well thought out asset allocation plan is essential both before retirement and after, but consideration must also be given to the specific investments that you choose. So the broad picture asset allocation is very, very important, but the specific investments that you choose are just as important. There are many different investment options, as you know, and it's impossible to discuss them all here. Nevertheless, it's worth mentioning a few choices that might have a place in the income producing portion of your overall strategy. Bonds can help you address investment goals in many ways. Buying individual bonds at their face value and holding them to maturity can provide a predictable income stream, and it can provide you with the assurance that you'll get your principal back once that bond matures, unless, of course, the bond issuer defaults. You can also buy bonds through mutual funds or exchange-traded funds, although these funds have no specific maturity date, and the fund values will fluctuate. Other investments that provide income are dividend-paying stocks and mutual funds or exchange-traded funds that invest in dividend-paying stocks. However, dividends may not provide as predictable a source of income as bonds because they are issued at the discretion of the company's board of directors. Now, preferred stock dividends, though, these will pay a fixed dividend before any dividend is available for common stockholders. So a little more security there. Some other alternatives include bank CDs, Treasury inflation-protected securities, and distribution mutual funds that are designed to provide an income stream from year to year, but with really no guarantee that the income will last as long as you need it to. So just keep that in mind. There's one other type of investment option that has become somewhat synonymous with retirement income planning, and that would be annuities. An annuity is a contract between you and an annuity issuer, that is an insurance company. In the most general terms, you pay money, or we call it a premium, in exchange for the insurers or issuers' promise to make payments to you for a fixed period of time, or potentially even for your lifetime. Annuities are able to provide something unique, which is a guaranteed income stream for the rest of your life, or for the combined lives of you and your spouse. Although that guarantee is subject to the claims paying ability of the insurance company. The obvious advantage in the context of retirement income planning is that you can use an annuity to lock in a predictable annual income stream, not subject to investment risk, that you can't outlive. In return for this guaranteed income stream, you may have to give up control of your funds. So annuities are not going to be as liquid typically as other investment options. You get a fixed income, but in some cases you may not have the flexibility to withdraw extra cash if you need it. Generally speaking, annuities do not provide as great of a potential return as other investment options, because when fees and expenses are factored in, they just tend to not perform or not have the potential to perform quite as well. The bottom line, annuities can be a full or partial solution when it comes to retirement income planning, since they can offer stable, predictable income payments, but they are not right for everyone. So you just want to be cautious with any investment. We like to say there's no evil investment per se. It's just we look at each one and see if it's a right fit. Although there are some investments out there that I certainly don't recommend. But generally speaking, there's a time and place for everything, and that's where you want to be very careful to plan and look at all the pros and cons. Your retirement income plan depends not only upon your asset allocation and your investment choices, but also on how quickly you would draw down your personal savings. No, this is not coffee. I was drinking coffee earlier. Now switched to water. So thank you for staying with me. I know it's late. We're almost finished. Basically, you want to withdraw enough to provide the current income you need, but not so much that you run out too quickly, leaving nothing for later retirement years. The percentage that you withdraw annually from your savings and investments is called your withdrawal rate. The maximum percentage that you can withdraw each year and still reasonably expect not to deplete your savings is referred to as your sustainable withdrawal rate. There are many strategies and models that are used to calculate sustainable withdrawal rates. Some suggest withdrawing a percentage each year, a fixed percentage. Some promote a rate based on your investment performance each year, and some recommend a withdrawal rate based on age. Factors to consider include the value of your savings, the amount of income you anticipate needing, your life expectancy, and the rate of return you anticipate from your investments. Also, inflation, taxes, and whether you're planning for 1 or 2 retired lives is very important in calculating that. To give you some idea, though, of the percentage that we're talking about, for many there is a basic assumption that an appropriate withdrawal rate falls in the 4 to 5% range. Particularly important in early years of retirement is the withdrawal rate, because you may not have as much time to recoup in those early years, because you're already starting to take money out, and those early years are very important because that value needs to be maintained so that it can grow for the compounding interest that you're going to need for the long term of retirement. So the early years are even more important than the later years. All right, you may have assets and accounts that are tax deferred, and you may have some assets and accounts that are taxable. Given a choice, which type of account should you withdraw from first? One approach to consider is withdrawing money from taxable accounts first, then tax-deferred accounts, and lastly, any tax-free accounts. The idea is that by using your tax-favored accounts last and avoiding taxes as long as possible, you'll keep more of your retirement dollars working for you on a tax-deferred basis. I tell people it's kind of like running a race without any weights on your shoulders. If you don't have the taxes, those tax-deferred and maybe even tax-free accounts can run a little faster potentially, and so you want to leave that money alone as long as possible. That's not always the best strategy, though. If you're concerned about leaving assets to beneficiaries, estate planning concerns might influence your withdrawal decisions. For example, if you have appreciated or rapidly appreciating stocks or any asset for that matter in a taxable account, in some cases it may make sense for you to withdraw assets from your tax-deferred and tax-free accounts first. The reason would be that appreciated assets held in a taxable account will generally receive a step up in basis at your death, at your passing, while assets held in a retirement account do not. As with so many other things when it comes to retirement income planning, there's no easy answer. The decision over the order in which you should make withdrawals depends on your individual circumstances, including your asset allocation, tax consequences, withdrawal fees, surrender charges, any costs potentially associated with each particular option. And I've moved ahead on my slides, but let me just mention this real briefly. There is, though, one aspect of retirement withdrawals that isn't discretionary at all. We really don't have a lot of choice in it. With some accounts, even if you don't want to withdraw funds, you may have to. You're required to start taking annual distributions called required minimum distributions from traditional IRAs, not Roth IRAs, but traditional IRAs, by April 1st of the year following the year that you turn 72. It used to be 70 and a half, but it's been changed to 72. The same rule applies to employer plans like 401ks and 403bs, unless you continue to work for the same employer that's sponsoring that plan, in which case you can generally defer taking required withdrawals until the year that you retire, even if it's after age 72. The penalty for getting this wrong is severe. If you withdraw less than your required minimum distribution, you have to pay a 50% penalty, tax penalty, on the amount that you failed to withdraw. So it's important that you get that right. Required minimum distributions can affect your income and need to be considered when planning to withdraw from savings. By the way, due to the Coronavirus Aid, Relief, and Economic Security Act, CARES Act, required minimum distributions are waived in 2020. Finally, although we haven't discussed it at all, really, there are other sources of retirement income that might potentially be available to you. And I'll just mention them real briefly. For example, if you've built up substantial home equity, it's possible that you could tap that home equity as a source of retirement income, either by selling the home and downsizing, or by borrowing against the value of the home, which this should be explored with caution, but it is an option for folks who need to generate some retirement income. It can be an option. Another example, an existing permanent life insurance policy that has some cash value can sometimes be a source of retirement income, although policy loans and withdrawals can reduce the cash value, reduce or eliminate the death benefit of that policy, and have some negative tax consequences. So you want to be careful how you do that. In conclusion, I'd like to just recap what we've discussed tonight so far. Talked about when to retire. That's very important. How long a period should you plan for? How much annual income will you need? How much annual income can you expect from Social Security and employer pensions, calculating that? And then the third leg of the stool, your personal savings, making sure that Those are invested in the proper asset allocation, that you are in the right types of investments, that your withdrawal rates are appropriate, your order of withdrawals is correct, and then other potential income sources to consider. Finally, in this series that we're calling Method to My Money, we not only want to provide you with some timely education on methods that can help you master your money, we also want to share some timeless truths that we hope you will find beneficial as you think about money, madness, and the pursuit of lasting wealth. Proverbs 8:18 says, "Riches and honor are with me, enduring or lasting wealth and righteousness." In that proverb, King Solomon, who was described as the wisest man who ever lived, stated that along with wisdom dwells riches, honor, lasting wealth, and righteousness. We've all experienced the passing thrill or high that comes along with a new purchase, whether it's as a small child, maybe getting a new toy for Christmas, or as an adult, getting a new car, outfit, or a new home. The excitement fades, doesn't it? And we are left searching for the next new thing. Here on Method to My Money, I want to encourage all of us to set our sights a little higher, to strive for that which embodies wisdom. And with it, I mean, we will find true riches, honor, lasting wealth, and righteousness, according to the proverb. So just something to think about. Well, we have just enough time for questions. I'm going to just check and see if we have any questions out here, and I don't see any. Just keep in mind, of course, you can email us, mhearn@cannon-wealth.com or info@cannon-wealth.com, and certainly we can get back to you with an answer to your questions. Love to help any way we can. Just please keep in mind every month going forward, at least until we run out of things to talk about, we're going to have a new episode of Method to My Money, and we're going to be talking about all types of different topics that we get a lot of questions on. So I hope you can join us second Tuesdays monthly at 6 p.m. Well, that's all we have time for tonight, and I appreciate, again, you being here. Thank you, and I'll just show you a couple of disclaimers here. Remember that this webinar will also remain on our Cannon Wealth Management Facebook page. We'll post a replay to our website and YouTube channel as soon as possible. And please, if you found this information helpful, consider sharing it with friends and family members. Thank you again, and have a great evening.
I'm Matt Hearn, and this is Method to My Money.